5 mistakes. That's all it takes to turn a good investing decade into a mediocre one. Not bad luck, not a market crash, just 5 quiet habits that almost nobody warns you about, because none of them feel like mistakes while you're making them. They feel like normal, responsible investing. That's exactly what makes them dangerous. I'm going to walk you through all 5 with real numbers so you can check your own accounts against this list before this video ends. Some of these you'll recognize right away. 1 or 2 might genuinely surprise you. These aren't the flashy mistakes people brag about avoiding. These are the quiet ones that compound in the background for years before you feel the damage. Mistake number 1, paying for an expensive fund that does the same job as a cheap one. Here's what almost nobody tells beginners. A fund that charges you 1% a year and a fund that charges you 0.05% a year can hold almost identical stocks. Same companies, same general performance before fees. The only real difference is how much of your money gets quietly skimmed off the top every single year forever. That 1% doesn't sound like much when you're starting out, so let's run the numbers properly. Take $10,000 growing for 30 years. One version pays that extra 1% in fees every single year. The other doesn't. The expensive fund grows to about $76,000. The cheap index fund grows to about $99,000. Same market, same 30 years. The only difference was the fee. That gap is over $23,000 gone. Not because the fund performed worse, but because it charged more to do basically the same job. This is the most common mistake on this list because it's completely invisible. You never get a bill in the mail. You just see a slightly smaller number every single year for decades. 2 funds can sit right next to each other on your screen, tracking the exact same index, and most people would never think to check which one is quietly charging 20 times more for nearly the identical result. Mistake number 2, putting everything in the wrong type of account. This one isn't about what you buy, it's about where you buy it. And honestly, this is one I see people mess up constantly, even smart, educated people who otherwise do their research and think they're being careful. A lot of beginners open a regular taxable brokerage account, put money in, and never touch the accounts specifically designed to protect you from taxes, like a 401k or a Roth IRA. They just assume all investment accounts are basically the same thing. Here's why that matters. In a taxable account, you can get taxed on dividends every single year, and you get taxed again on gains when you eventually sell. In a Roth IRA, that same money grows completely tax-free, and you never pay taxes on it again when you take it out in retirement. A 401k works differently depending on whether it's traditional or Roth, but it still shields your money from taxes either now or later. Skipping these accounts isn't catastrophic the way some mistakes are, but it's like willingly paying extra tax for no reason, year after year, simply because nobody told you these accounts existed or you assumed they were too complicated. They're not. Opening one takes about the same 15 minutes as opening any other account, and the money inside can usually go into the exact same index funds you'd buy anywhere else. You're not changing what you invest in, you're just changing the box it sits in, and that box decides whether the taxman gets a cut or not. This one compounds quietly for decades, and most people only notice it much later when they run the numbers. Mistake number 3, investing with borrowed money you didn't realize you borrowed. This is margin trading, and it's the mistake that can turn a bad month into a financial disaster. Usually for people who never fully understood what they signed up for when they clicked Enable Margin. Here's how it actually works. Some brokerages let you invest with more money than you actually have by lending you the difference. You put in $10,000 of your own money, borrow another $10,000, and suddenly you're investing with $20,000 total. If the market goes up, this feels incredible. Your gains get doubled. But here's the part that destroys people. If the market drops 25%, your $20,000 position is now worth $15,000. You still owe the $10,000 you borrowed, so your actual equity just dropped from $10,000 to $5,000. A 25% market drop turned into a 50% loss of your own money. Markets do drop 25% sometimes. It's not rare. What's rare is beginners understanding that they've doubled their own pain on the way down. Worse, brokerages can force you to sell at the bottom through something called a margin call, locking in the loss at the worst possible moment instead of letting you wait it out. Margin isn't evil, but for most beginners, it's a tool they didn't know they were holding by the blade. Mistake number 4, putting too much money into one company because you like it. This one feels smart while you're doing it. You believe in a company. You've used their product for years. You watched the stock climb, so you put a huge chunk of your money into that one stock instead of spreading it across an index fund that holds hundreds of companies. The problem isn't that the company is bad. The problem is concentration. If that one company has a bad year, a scandal, a failed product launch, or a CEO misstep, your whole portfolio takes the hit at once. An index fund spreads that same risk across hundreds of companies, so one disaster barely moves the needle. People always remember the one friend who got rich putting everything into a single stock. Nobody talks about everyone else who did the same thing and lost half their savings when that one company stumbled. Survivorship bias is the technical term, but the simple version is this. You're not hearing about survivors representing the average outcome. You're hearing about the lucky exception, and building a strategy around an exception is how beginners lose the most money while feeling the most confident.
Mistake number 5, never rebalancing, ever. This is the quiet one. You set up your investments once, you walk away, and you never look at the mix again. That sounds like the set it and forget it advice we've talked about before, and to an extent, it is. But there's a difference between automating your contributions and never checking your allocation at all. Here's the problem. Say you start with 80% stocks and 20% bonds. After a few good years, stocks have grown so much that you're now sitting at 95% stocks and 5% bonds, without ever deciding to take on that much extra risk. Your portfolio drifted there on its own, quietly, while you weren't looking. Then a downturn hits, and you're far more exposed than you ever intended to be. The risk you signed up for quietly turned into a risk you never agreed to, just because you never glanced back at the numbers. Rebalancing just means checking in once or twice a year and nudging your mix back toward your original target. It's not complicated. It just requires remembering that your portfolio is a living thing, not a photograph you take once and frame forever. This one sneaks up on people who think they're being responsible by staying hands-off. So there they are, 5 mistakes. And notice that none of them are about picking the wrong stock or timing the market badly. They're quieter than that. High fees you didn't notice, tax accounts you never opened, borrowed money you didn't think of as a loan, one company you trusted too much, a portfolio you never checked again. None of these mistakes will show up as a single bad headline. They show up 20 years later as a number that's smaller than it should have been, with no single moment you can point to and say, that's where it went wrong. Here's your homework. Go check one thing right now, the expense ratio on your largest holding. If it's above 0.5%, you're probably making mistake number 1 without even knowing it. While you're there, glance at which account it's sitting in, and ask yourself honestly when you last looked at your overall mix. Comment below with your expense ratio. I want to see how many of you are paying more than you think. Plant your money where it grows fastest, in an account built to protect it, without leaning on debt to get there. That's the whole game.